Thank you, Aman. Good evening, everybody, and welcome to HDFC Asset Management Company's 4K FY19 call. To discuss the results, we have Mr. Milind Barve, Managing Director, Mr. Piyush Surana, Chief Financial Officer, and Mr. Simal Kanuga, Chief Investor Relations Officer of the company. May I now request Simal to just brief us on the numbers, and then we can go ahead. Over to you, Simal.
Thanks, Amit, and thanks, Team JM, for hosting this call. So good evening, everyone. We will, as usual, start with a quick overview of the quarter and the year that has gone by. We have Milind and Piyush both here who will take questions thereafter. The presentation that we can refer to has been uploaded on our website as well as that of the exchanges. In terms of the industry, the MF industry AUM grew by over 11% during financial year 18-19. Equity-oriented schemes saw net inflows to the tune of rupees 1.18 trillion. The quarter ended March of 2019 saw equity flows of approximately 178 billion. The industry continues to see further shift to individual investors in terms of percentage of overall AUM. The SIP book for the industry now stands at over rupees 80 billion. That is in terms of monthly inflows. So during the month of March, we saw over 80 billion coming in through systematic investment plans into the industry as a whole. In terms of our business, the total AUM as of 31st March was 3.44 trillion rupees, of which 48% is in equity-oriented assets and balance 52 in non-equity oriented assets. We now enjoy a trust of over 5.3 million unique investors across 9.1 million live accounts. During the financial year that went by, our overall AUM grew by 18% and equity-oriented AUM grew by 13%. Market share in terms of overall AUM now is at 14.5%, while that in actively managed equity-oriented AUM is at 16.2%. This means that we continue to retain our leadership position in total AUM as well as actively managed equity-oriented AUM. We continue to be the most preferred choice of individual investors with market share of 15.4% in individual AUM. In terms of number of unique investors, our market share has actually grown and now it is 28%. Our systematic transaction book continues to remain stable. We saw inflow of over 11.8 billion rupees during March of 2019 through systematic transactions. This came across 3.38 million customer accounts. Our distribution mix, as always, has been highly diversified. We continue to retain our number 2 spot in terms of B30 AUM. Before we dive into financials, we would like to remind you of SEBI's 22nd October circular, wherein the regulator has prohibited payment of upfront commission and has further mandated that all scheme-related expenses, including distributor commission, shall have to be paid by the scheme and not the asset management company. As a result, our expenses have decreased since scheme-related expenses are now borne directly by the scheme. As a consequence of this, expenses now being borne by the scheme, the investment management fee they pay to the company will reduce by a commensurate amount. The financials for the year March 31, 2019 have been prepared in accordance with Ind AS. Accordingly, financials for the previous year, which were prepared under GAAP, has been adjusted for comparative purposes. In terms of numbers, for financial year March 19, we have reported a PAT of rupees 9306 million, so that is 930.6 crores, a growth of 31% over the previous financial year. Our operating profit from core asset management business was at 12331 million, that is 1233 crores, a growth of 30%. PBT was 13747 million, a growth of 30%. In terms of quarter ended March over March of 19 versus March of 18, we have reported a PAT of rupees 2762 million, a growth of 61% over the same quarter of the previous financial year. Operating profit from core asset management business was rupees 3634 million, a growth of 48%. PBT was rupees 4146 million, a growth of 50%. We would like to definitely reiterate the fact it would not be prudent to compare revenues due to changes affected by SEBI circular dated 22nd October. We would also want to repeat this. During the course of FY 2018-19, we have fully provided for our exposure in preference shares of ILFS. We had exposure of rupees 400 million, 40 crores that is, to this particular investment in the books of the asset management company. We had already provided approximately rupees 300 million in the first 9 months of the current financial year and have provided for the balance in the quarter that just went by. Our operating profit margin as a basis points of AUM now stands at 37 basis points. This was 34 basis points for the financial year 2017-18. We have further increased our dividend payout ratio as compared to 56% for the financial year 2017-18. The payout ratio for the year that just ended has now gone up to 66%. This includes the interim dividend that we paid in March of rupees 12 per share, and the board today has recommended a final dividend of rupees 12 per share, which is subject to shareholder approval. We will now leave the floor open to questions. So I have both Milind and Piyush here, and they'll be happy to take any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mr. Pransu Mishra from BOB Capital Markets. Please go ahead.
Thank you for the opportunity, sir, and congratulations on a good quarter.
Mishra, your audio is breaking, so may I request you to use a handset, please?
Yeah, I'm in conference. Can you hear me?
Yes, the audio is still breaking.
Hello. Yeah.
So may we request you to come in a network area, please?
Yeah, I'm in a network area. Can you hear me?
Not very much clear.
Hello.
Yes, you are now audible. Please go ahead.
Okay, so a couple of questions. The first question is with respect to the liquid funds which had a inflow in the third quarter of redemption.
Breaking.
Hello.
I'm sorry, we'll have to move to the next question, sir. I would request you to join the question queue and reconnect, sir. Thank you. The next question is from the line of Amit Nanavati from Nomura. Please go ahead.
Yeah, hi, sir. Just wanted to check on one thing. Basically, your core EBIT, if I look at in 4Q, it's been exceptionally strong at 40 basis points. And this is in context where in the past 2 quarters, because of liquid flow, your equity mix has declined. And there has been some benefit of removal of upfront commissions as well. And that will take some time to flow into, trail commissions. But just wanted to understand what portion of your flow or your equity stock would already be on a full trail model before these upfront commissions were removed. Hello. 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 Hello.
Yeah. Yes, Mr. Nanavati, please stay connected.
Thank you for your question.
Hello.
Hello, can you hear me now?
Yes.
Yeah.
Yes. Okay. So thank you for your question. I must want to clarify that even before the upfront commission was banned, roughly about a third of the flows or the AUM were on a full trail model. The other flows and the AM as well had some element of upfront commission on it. The upfront commission is not consistently 1%, it is sometimes a little lower. So that was the breakup between full trail and upfront plus trail before the change happened. As you are now aware, now the entire AUM as well as the new flow will come on full trail basis.
Right. So basically over the next 2 years, as your entire stock gets replaced by a new flow, which will be only upfront, only trail model, and ignoring the TER cut that's happened from 1st of April, what is the kind of benefit that you would have gained in the last 2 quarters, and what is the normalization one should expect in the next 1-2 years?
Very roughly speaking, the benefit we get from the upfront commission is as follows. We have been charging the upfront commission and to the P&L over a period of 12-month basis. So whatever upfront we were paying, we were dividing it by 12 and we were taking a charge earlier. Now there are no upfront payments at all, but there is a continuing charge of the upfront that we had already paid before 22nd October. That charge will get run down by, let's say, October 2019. After that, we will only have the trail commission. So until October 2000, September full month and few days of October, we will benefit from the savings on the upfront commission, which is hitting the P&L. Just to complete the answer, on an average basis, if somebody, I'm giving you more as an example, if somebody was paid 1% upfront commission, now we are not paying that 1% anymore. His trail fee has been increased by about 30 or 33 basis points approximately.
Correct. Yes, sir. So the question rather was that since you'll have benefit accruing till October, but the normalization of that 30 bip now flowing into trail, that will also happen over the next 2 years, right? So to that extent, what's the kind of normalization in the revenue drop one should look at?
No, that is already happening from the 23rd of October even now also, because the higher trail fee is not something that is going to come after October. The higher trail fee is already made effective right from 22nd October itself. So there is going to be
only on the new flow that would be, right? Not on the stock which is already there sitting.
No, on the stock that is already with us, we would have already paid upfront, so there is nothing more to be paid. So there is going to be no such P&L impact of any on profit. In fact, the benefit will accrue till September. After that, it will remain constant. There's nothing. Cost will not go up after that.
Okay. And secondly, I want to check if you can detail in terms of the TR cut, what's been shared both in terms of stock and flow separately.
Right. So the TR, as we had mentioned, is about 24 or 25 basis points impact on our equity AUM and one particular debt fund, or one or two other debt funds. The impact that we have totally was about 25 basis points. We have now, effective from 1st April, already passed on close to about 21 to 22 basis points, 21 and a half or 22 basis points approximately. So we will be taking impact on the book of about 3.5 to 4 basis points on the equity portion of the AUM, which we have already factored. But in the same breath, let me also mention that as you would have seen, that our operating profit margin has seen a meaningful expansion in this current year. So what we will expect is to be able to absorb the 4 basis points as a part of what we are already planning to do, and which we had mentioned almost 2 quarters back when this new regulation was announced.
And even on the flow, it's just 3 to 4 basis point of absorption, or
no, flow is not connected with the book. The flow, see, whatever we were paying as trail, that will get dropped by the 21 or 22 basis points, 21 basis points approximately. The flow has a separate pricing model itself, where there is basically a certain percentage of the TR is being paid as the commission. Now, as you know, it is only the trail commission. So approximately in every product, whatever is the TR, anywhere between 60, on an average 60 to 65 basis points is shared with the distributor, 35 to 40 basis points is retained as the AMC.
Okay.
I'm giving you approximate numbers. This is the average at the company level. At each distributor level, it will be different.
Sure. That's about it. Thank you.
You're welcome.
Thank you. The next question is from the line of Aman Shah from JT Investments. Please go ahead.
Hello. Thank you for taking my question. My question is, we have in India where we say equity AUM as a percentage of GDP is around 6%. While we also have FII investment, which is roughly around 25% of GDP. So my question is, when we have institutional ownership of equities at around 30-32%, do you see adoption of passive funds in India over the next 5 to 8 years increasing speed? Like, because we have even in US where the institutional ownership is 60% of GDP equity ownership. There, the large amount of funds are still passive oriented.
Thank you for that question. I mean, our view very clearly is that in India, the retail investors are absolute return seekers, and Indian fund industry, including our fund house, has been able to beat the benchmark over 3 and 5 years quite with a reasonable margin. And even in the 1 year, we have a number of funds which have beaten the benchmark. So whether it is the industry or us, where the fund performance is beating the benchmark, the case or the rationale for investors to put money in passive funds or index funds or ETFs does not exist. And this is also borne by, since the ETFs were launched in India, the share of the ETFs in the total business has been fairly small. It is less than 5 or 8% of the total equity AUM of the industry. And that also is predominantly invested by one large institutional investor, which is the EPFO. So we still believe that Indian markets, Indian fund managers will continue to deliver outperformance over their benchmarks. So investing in benchmark indices like ETFs will be, I don't think we don't see that as a threat at all right now.
Fair enough. Thank you.
question is from the line of Ritvik Sheth from Deep Finance. Please go ahead.
Hi, thanks for the opportunity. Sir, is it possible to quantify the impact of the semi-circular in the current quarter, since it was the first full quarter where the expenses were lower?
In the current quarter, we have already mentioned almost 2 quarters back that when the announcement was made, we had calibrated what will be the impact on our AUM at that time. It was 24 basis points. Now the AUM has gone up from the 2 quarters back, so it is 25 basis points.
No, so I'm talking about the lower expenses in the quarter because of no upfront commissioning.
Sorry, sir, you're not audible.
Yeah.
I'm sorry to interrupt you, sir. You are still not audible.
Hello?
Yeah.
Yeah, see, we can't quantify it in terms of numbers because there are a number of things happening. One, there is these expenses moving from the books of the AMC into the books of the scheme.
Okay.
And these are expenses which are, besides the commission, even the scheme-related expenses are shifting there.
Okay.
That's one. The other thing is this whole amortization cycle which is running down. The effect of that is also there.
Okay.
So we won't be able to specifically quantify the effect in this quarter.
Okay, sure. That's it from my side. Thank you.
Thank you. The next question is from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Thank you for taking my questions. Congratulations on a good set of numbers. My first question is, given that you mentioned that you're passing around 21, 22 bips to distributors, are we not risking a distributor backlash, especially when it comes to banks and national distributors, the large distributors, who can then kind of advise churn to their clients? So your thoughts on that? And my second question is, it seems that the profitability on the incremental flows, if it stays with us for a longer period of time, is lesser than the previous model where we paid a certain amount upfront and the trail was a lot lower. So how do you guys think of it? And what would you prefer if you had the option? So, yeah.
2 questions. The first question was, I think you asked about the distributor backlash. I think we understand that almost every asset management company that we are speaking to is going to do the same thing, which is passing on the reduction in the TR in the form of reduction in the commission payout. So in that sense, we believe we are not doing something unique or different from what most of the other players and certainly some of the larger players are doing. Even having said that, at the end of the day, our commissions will still remain reasonably competitive as compared to what our peers will be paying. And we also believe that if our fund performance is competitive, we should be able to get and retain the market share that we have, leadership we have, particularly in the equity AUM business. Your second question was on. Yeah, so
business model shift.
Yes. Now, see, if it is true that we were paying upfront commissions, but the overall commissions that we were paying, where we were paying upfront commission, it was also making the business vulnerable to change because the upfront commission was getting clawed back only for the first 12 months, which means that if an investor came for 13, 14 months, there was an upfront commission paid plus a trail fee was paid. So now there is a clear saving. There are 2 ways in which we benefit. One is that the savings in the upfront, which is an obvious saving. The trail will continue to be the advantage of this, why the new proposed method is better, is because it is consistent with the asset staying with us as a part of the AUM, that we will continue to earn the fee and proportionately we will be paying to the distributor. In the past, if there was assets which went out and some assets did indeed used to go out after the first 12 months, then the total cost of that money gave us almost very little or any margin because of the upfront charge already being paid, and we were not able to recover it once the 12 months were over. So on balance, we are happy with the full trail model. It will take an extremely long time before it will start showing up in the margin reduction, if at all. It will see the business benefits from two drivers. The equity AUM benefits from the growth in the AUM because of valuation gain, in which the costs do not increase or change. The second driver of growth is the new business flows. Now, the new business flow will probably, if that is material, then that could impact the margins in the future, because the new business flows are priced slightly higher than the book AUM. But if the new flows are indeed very strong, then the way I would put it, it is a good problem to have as compared to less flows.
Got it.
Yeah, and in our case, we benefit from having a very large book. So for us, the book is as valuable or more valuable than just necessarily looking at the flow.
Just one follow-up. Can you give some color on the age of the book? So what part of the portfolio is, what part of the equity AUM is, more than 1 year old, 2 year old, and let's say 3 year old, and how the 3 year old book has been over a period of time. So,
unfortunately, we don't have immediate data. I mean, see, that book changes every day in terms of, because of new flows are coming in every day, every month. So that would be something that will remain fairly dynamic. I would say the average life of an investment when it stays with us, as measured by way of measuring the redemptions when they go out, is roughly about close to about 2 years. It's a little over 2 years.
So in that sense, on an average, the new method is still more profitable because you amortize the upfront over a period of 3 years, or because that's what you've done.
Yeah, we actually are fine with the new method because it is simply consistent with the assets staying with us. We are not paying for 1 year money.
Right. All right. Thank you. Best of luck for the future.
Thank you.
Thank you. The next question is from the line of Rohan Advant from Multi-Act. Please go ahead.
Yeah, sir, thanks for the opportunity. So my first question was regarding an understanding on the impact of TER starting this April. You said there would be a 4 to 5 basis points absorption that we'll have to do. Is this on the Q4 base of our operating profit to AUM or FY19 base of operating profit to AUM? Because the profitability seems to have improved significantly in Q4.
So there are two drivers, as you have noticed, that the profitability in terms of operating margin has already expanded. So that has created the room for us to absorb the margin fall that will happen. So that margin fall will start getting reflected from the first quarter, but we believe that our margins will still be able to sort of use the operating leverage from the business that we have, because our employee and other fixed costs, they grow at a very, very low rate. So this is a business of scale, and it has a tremendously positive impact on economies of scale. So, yeah, as my CFO is pointing out, the 4 or 5 basis point is on the equity AUM, which is roughly 48% of the total AUM. So the impact on the entire business will be proportionately hardly 2 or 2.5 basis points.
Got it. Yeah. Sir, and my second question was regarding trail commissions. What would be the differential between the trail commissions on existing book versus new flows?
That varies from every distributor, so we do not have a number which will show you, which can actually tell you how much is the exact difference between new flows and the book pricing.
Okay, sir, the reason I asked this question was, are the new rules going to reduce the switching that is being done by distributors and create more stickiness to our flows, in your opinion?
We do believe so very much, because there is now no commercial incentive for a distributor to. We don't, first of all, believe that it is always the distributor who is inducing the churn. Many distributors are extremely high quality and believe in long-term investing. But if at all there was anything that the investor did to create higher commissions in the upfront regime, then that does not matter. So now we don't expect people will move from product A to B simply for there is a small differential in the trail commission. It is not compelling enough for anybody to advise a churn just to get some differential trail commission.
And my last question was that larger schemes will now have lower TERs and vice versa. So would this incentivize the channel to push smaller schemes, and our impact the impact on us because we have a large number of large schemes?
I would say firstly the channels we believe are very professional, and I think the first criteria for them to recommend a fund is investment performance more than a small differential in the TR or the trail fee. In one sense, if the TR is lower on a larger fund, it is actually more advantageous to the investor to invest in a larger fund. But if you have investment performance which is competitive, then the distributor is more incentivized to recommend because he has his own reputation and relationship at risk. So he will clearly want to recommend something which is, in his view, is appropriate to the customer and also has competitive investment performance.
Got it. So those were my questions. Thanks for taking them and all the best for them.
Thank you.
Thank you. The next question is from the line of Adesh Mehta from Ambit Capital. Please go ahead.
Hello, sir.
Yes, Adesh.
Yes, sir. We have seen that in March the inflows have almost doubled in equity schemes. Are we seeing that sustaining? Already 26 days have passed in April.
We won't be able to comment on anything in April, because the data for the industry is not available.
Yep.
But yes, if you see the industry numbers, they were about 4,000 and 5,000 in February. It was 5,000 in Jan, 4,000 in Feb. They improved to about 8,000 on a consolidated basis in March.
Right.
It's difficult to. We don't have industry numbers in the middle of the month.
No, but internally, are we seeing, at least for us, that trend sustaining?
It's difficult to say. I mean, see, obviously there are a number of factors. It is the state of the market. We have an election which is around the corner, election outcome. So I think it is reasonable to expect some tentativeness on investors to hold back or defer decisions for a short period of time. So we believe that people, even if they redeem, they have the money and will come back into the markets because that we don't see very clear avenues that money is shifting to.
Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Arjun Ashar from Envision Capital. Please go ahead.
Hello, sir. What have been the trends in net flows in equity for you for the past 3 years?
Last 3 years?
Yes, 3 financial years. What have been the trends in net flows into equity?
So let me put it this way, that we have been able to maintain our equity market share around 16%. It was 16.8 last year. It is 16.2. That's a combination of investment performance, that is a valuation gain, as well as net flows. We don't disclose net flows separately for the AMC because these are not published by any of our competitive players, our peers as well.
Okay, but overall, are you satisfied with the extent of penetration of equity mutual fund product in the country for the last 3 to 5 years versus the trailing 3 to 5 years before that?
Certainly, if you look at the flows over a larger period of about 5 to 8 years, since 2014-15, before 2014-15, the trend of flows was actually negative 11,000 and 14,000. But from 14-15, they turned positive of the order of almost 80,000 crore, went to 85,000, went to 93,000. And then the year before the March 2019, which is March 17-18, it went to a staggering 240,000 crores. I think what we have seen this year, the industry number has come down from 240,000 crores, which I would treat more as more of an aberration year. It was largely driven by the demonetization effect. This year, the industry has cumulatively done 119,000 crores of new flows in equity products. When I refer to equity, I'm referring only to actively managed equity funds, not ETFs. So that flows has been a 119,000 crores, which is a run rate of roughly 10,000 crores a month.
Okay.
And I think it is kind of normalized from that extremely high number of 20,000 crores a month, which was the previous year.
Okay. And in our equity AUM, what percentage of our exposure would be to large caps? Because you have variety of schemes and the portfolio is disclosed, but you would have a collated rough estimate.
So we have a large cap fund which is called the HDFC Top 100, which is about 16,000 crores in terms of total AUM. See, mid and small is about 27,000 crores between small and mid. The others are either in multi cap or large cap. you.
Thank you. The next question is from the line of Nitin Rao from Alpha Ideas. Please go ahead.
Thank you, sir, for allowing me the chance to question. So my question is related to the distribution channel. I noticed that in last year, the banking channels, which includes HDFC Bank and other banks, accounted for 27 or 28% of our distribution network. And this year it has come down to, let's say, 22%. And the share of direct has gone up from 34% to 38%. Do you see this trend to play out in the coming years as well? And do you emphasize a scenario where direct can account for as much as 50% going forward?
So the first to answer the question on the direct business, it has gone on a total AUM basis from 34% to 38%. This is the total AUM which includes the liquid fund. As far as the banks are concerned, it is 14% and it was earlier 17%. So that there is a little fall in the bank's contribution. As far as HDFC Bank is concerned, this is all banks consolidated. So as far as HDFC Bank is concerned, they remain at around total roughly about from 10.3% to about 8.6%. So it's not a big fall.
So do you see the share of direct going up? What I mean to say is this the trend that you see playing out in the next coming years? That's my question.
Yes, we do see the trend of direct increasing. More and more people are becoming aware of the lower cost of direct plans and are opting for it. It is also being, to some extent, recommended or being triggered through the advisory channel who are recommending direct plans. The other source of these direct flows comes from people who are buying other product online and people who are walking into our branches. But I would say the recommendations from the advisors to buy into the direct plan is a large contributor, followed by the participation or buying into our products or through the online.
Thank you, sir.
Thank you. Ladies and gentlemen, the next question is from the line of Lakshmi Narayanan from Catamaran. Please go ahead.
Yeah, a couple of questions from my side. First question in terms of your branch expansion, what has been the expansion in the last 1 year? Second question is pertaining to other investment products such as AAF. If you want to really expand and AAF and PMS, how large it is. The third question is that you mentioned 37 bits on total AUM. How did it split between equity and debt? These are my three questions.
Your first question was on branches. We have 210 branches. Just to tell you that the previous year we added almost 35 to 40 new branches. In the last year we have not added to new branches, but in the current year we have a plan. As a part of our business plan, we propose to add 18 branches. So we usually look at some of the business parameters surrounding the industry and our own business, and then we plan to add branches, usually in small locations or new towns, and sometimes very rarely additional into the metros. So that is as far as branch is concerned. The AIF and PMS business, we do have a PMS business. It's not a very large part of our offering. We do believe that mutual fund houses, we do have a separately managed business under the PMS, which is where we manage international mandate. The international mandate for the total PMS business, including international mandate, is almost 9,500 crores. So we are not in AIFs right now, and we do not have any immediate plans to be in AIF. But the PMS, which includes international mandate, which is the order of about 9,000 crores.
Okay. Yeah. The third question is regarding the profitability of debt and equity, because you gave a 37 bits overall.
Very roughly, we don't. The profitability on equity is almost two times that of the debt. We don't disclose margins on each group of products, but debt is almost half as profitable as equity is, and that's why we believe equity is the core business, which is more revenue earning.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Samir Desai for closing comments. Thank you, and over to you, sir.
Thank you, everyone. On behalf of JM Financial, I would like to thank the management of HDFC Asset Management for joining us the call today. Thank you.
Thank you, everybody.